Into this. What if I told you that one of India's most iconic companies, a brand that absolutely dominates its market, is still completely misunderstood by almost everyone? We're talking about Eicher Motors. And you know what? The part everyone seems to miss? Well, that might just be the most important piece of the whole puzzle. Just look at this number, 88.9%. That is Royal Enfield's market share in India's mid-size motorcycle segment. Folks, that's not just market leadership, that's a near monopoly. It's an incredible fortress built on brand, on heritage, and pure aspiration. But here's the kicker. While everyone is completely mesmerized by the thunderous roar of a Royal Enfield, they're missing the hum of a totally different and equally powerful engine running in the background. So is the motorcycle brand the entire story? Not even close. So in this explainer, we're going to peel back all the layers. We'll kick things off with the monopoly that everyone sees, and then we'll reveal the hidden engine that most people just ignore. We'll look at the power of combining them, check out the company's next big moves into performance and electric, and then, finally, we'll deliver a verdict on what this all really means. Okay, first up, let's talk about the part of the business we all know and recognize, the dominant cash-generating machine that is Royal Enfield. I mean, the scale here is just staggering. We're talking over 1.2 million bikes sold in a single year. And the J-platform strategy, that's the real key to their expansion. See, with bikes like the Honda 350, they've managed to bring in a whole new, younger crowd without stealing sales from their iconic classic 350. They're not just defending their turf, they are actively expanding it. This is a brand with a deep cultural moat and some serious pricing power.
Okay, now for the fun part. Let's pull back the curtain on the other half of Eicher Motors, the industrial backbone that most investors completely forget exists. It's time to meet VECV.
So what exactly is VECV? Well, it stands for VE Commercial Vehicles, and it's a powerhouse joint venture with none other than the Volvo Group. Yeah, that Volvo. Together, they build the heavy-duty trucks and buses that are pretty much the lifeblood of India's economy. This business combines Eicher's incredible domestic knowledge with Volvo's global tech and safety leadership. It's a serious industrial player, literally the wheels of the economy.
And this slide just perfectly illustrates the two sides of the coin. On one hand, you've got Royal Enfield, the face of the business. It's all about emotion, aspiration. It's a high-margin consumer brand. And on the other hand, you have VECV, the backbone. It's industrial, foundational, and a super stable B2B business that grows right alongside the country's economy. Two totally different worlds, all living under one roof.
So, you might be asking, why does having these two very different businesses even matter? Let's break down why this combination isn't a distraction, but a massive strategic advantage. Okay, so the crucial point is this incredible synergy. Royal Enfield, with its premium bikes, is an absolute cash flow machine. It funds all the innovation and growth. VECV, on the other hand, provides stability. It's a hedge against the ups and downs of the consumer market because it ties the company's fortunes directly to India's infrastructure growth. And you know what? That stability is what lets Royal Enfield invest so confidently in these big, ambitious future bets. One fuels the fire, the other provides the rock-solid foundation. And you can see this power right here in the numbers. Just take a look at the consolidated results. Revenue is up nearly 23% year-on-year, and that strength carries right down the line, with operating profit and net profit also up big time. This isn't just a motorcycle company's performance. This is the performance of a diversified automotive powerhouse firing on all cylinders. And check this out. A consolidated EBITDA margin, which is a key way to measure a company's operating profitability, of 25.5%. To hit that kind of profitability while dealing with rising costs just shows incredible operating leverage and the kind of pricing power most companies can only dream of. It's the sign of a very healthy, very well-run dual business. So with the foundation this solid, where does Eicher go next? Well, they're aiming higher, literally. They're making a huge push into the world of high-performance global markets. This right here is the company's next big offensive. They're developing a brand new 750cc parallel twin engine, pushing into that 50 to 60 horsepower range. And for the first time ever, they're putting dual-disc front brakes on their bikes. We're talking about the upcoming Continental GT and Himalayan 750.
This isn't just an upgrade, folks, it's a statement. They are stepping off their home turf to take on the European and Japanese giants head-on.
Of course, you can't tell an automotive story these days without talking about electric. This is Eicher's high-stakes gamble on the future, and it's codenamed Flying Flea.
Now, what's really interesting here is how they're planning to tackle the biggest barrier to EV adoption, the cost. They're using a battery as a service model, or BAS. Basically, they separate the cost of the battery from the bike itself. This drops the upfront price from nearly 2.8 lakh rupees, that's 280,000 rupees, down to just under 2 lakh, making it way more accessible for people.
But here's the catch. They're taking their sweet time. The launch has been pushed back to the second half of fiscal 27. Now, on the one hand, this gives them more time to perfect the technology. But on the other, it means they risk losing that critical first-mover advantage to rivals who are already out there. It's a calculated risk for sure, and the market is watching very, very closely.
Okay, let's bring it all home. With such a dominant present and a really ambitious future, how should we think about the opportunities and the very real risks?
So, to put Eicher in context, you can see it commands a premium valuation. Its price-to-earnings ratio, which basically tells you how much investors are willing to pay for each rupee of profit, is over 36. That is significantly higher than its competitors. What this means is the market is pricing in a ton of future growth and continued dominance, leaving very little room for error.
And the risks are crystal clear. That high valuation is a double-edged sword. On the VECV side, exports have taken a pretty big hit from geopolitical issues. The EV delay is a gamble. Competition is definitely heating up. And on top of all that, new regulations requiring advanced driver assistance systems, or ADAS, are adding a big chunk of cost to their trucks. These are some serious headwinds they have to navigate.
So, it really just boils down to this. The bull case is that the 750cc platform becomes a global smash hit, exports bounce back, and the Royal Enfield brand remains absolutely untouchable. The bear case, on the other hand, is that the high valuation comes back to earth, the EV transition is too slow, and competitors finally start to chip away at their huge market share. But let's end on the single most important point. You have to remember, Eicher Motors is not just a motorcycle company. It's a dual-engine business. It's this unique combination of a high-margin, aspirational brand and a stable, foundational, industrial backbone. And that leaves us with the ultimate question. When you look at its valuation, what are you really seeing? Is the market correctly pricing this incredible dual-engine powerhouse? Or is it still just pricing in the roar of the motorcycle while completely missing the powerful, steady hum of the industrial engine in the background? The answer to that could be the entire story.